rising exposure and vulnerability of assets, to increasing frequency and severity of natural hazards and disasters, have devastating impacts that put a significant number of people and communities at risk. Reducing disaster risks entail a range of actions. Countries need to provide different actions. Disaster risk financing is one of the strategies of disaster risk management that can help support the agenda of reducing risks from disasters and climate change. Here are 10 basic things that you should know about disaster risk financing. Number 1. Disaster risk financing, or DRF, is about managing the risks through strategies that help countries ensure that their people and communities are financially protected in the event of a disaster. In the event of disasters, there will always be losses that must be financed. The burden of paying for the cost of responding and rebuilding from a disaster usually goes to governments. In many cases, the government acts as the insurer of last resort. DRF strategies help the countries become financially resilient to disaster and climate risks. Number 2. Ex-post risk financing versus ex-ante risk financing. There are many DRF mechanisms available to ensure that countries are financially protected against disaster and climate risks. Countries often deal with the unexpected financial effects of disasters ex-post, or after a disaster have already occurred. Ex-post disaster financing are often unplanned and ad hoc, and most of the time unreliable. Ex-ante risk financing, on the other hand, is planned and proactive financing instruments that are common options utilized by countries to deal with unexpected financial expenditures due to a disaster. Number 3. Risk can be transferred when governments shift the responsibility of paying for these damages and losses to another party. Risk transfer can be done through insurance, reinsurance, legislation, or other means. Number 4. Risk insurance is risk transfer, where governments can shift all or some of the burden to an insurance organization in exchange for payment of a premium. Number 5. There are other risk financing solutions available that countries can utilize to help mitigate and reduce risks. There are also funds created to mitigate the impacts of climate change and help countries build resilience to extreme climate events. Number 6. Risk pooling is another DRF mechanism that is available. Countries can come together and package their risks into one pool so they can have lower transaction costs and premium payments for insurance. The insurer can also utilize the pool to provide a more specific financial product that is tailor-fit to the needs of the users. Number 7. Another ex-ante risk financing tool is contingency budget, wherein governments can use their operating budget from other revenues to cover unforeseen disaster costs. Number 8. Risk assessment has an important role in disaster risk financing. Disaster risk can be measured by analyzing the trends of previous disaster losses as well as potential disaster events. By estimating potential losses, governments will be able to identify risk financing and risk transfer solutions suitable for specific types of risks. Number 9. Timely disaster response, recovery, and reconstruction are possible with disaster risk financing. Governments, through effective DRF mechanisms, can expedite response, recovery, and reconstruction in order to build back better and more resilient communities after a disaster. Number 10. The challenge of countries being more financially prepared and resilient is a challenge that disaster risk financing is addressing. With DRF strategies embedded in the disaster risk management agenda, countries are financially prepared to protect their populations and communities against disaster and climate risks. To learn more about the ASEAN Disaster Risk Financing and Insurance Program, visit adrfi.org.